Good afternoon. Welcome to another edition of Forensic Focus. I am your host, Charles Amodio with FAZ Forensics. At FAZ Forensics, we specialize in business valuation and forensic accounting. When answers matter, FAZ delivers. Today, I'm here with my partner, Dave Consigli. Dave, how you doing today?
I'm doing great, Charlie. How are you?
Good, good. What's new in your world?
Oh, just kind of plugging along, getting things ready for year end. It's usually a busy quarter towards the end of the year. We usually have a lull in the beginning of the year. Kind of business owners are doing their budgets and maybe doing some planning, maybe doing some gifting of shares before the end of the year. That's not as prevalent as it used to be because of the unified credit and being so high, and people transferring their assets. They have to have quite a bit of assets, but still some succession planning
Okay,
that people do. And, the valuation world gets a little bit busy at the end of the year. Like we always said, business is great, but we're always looking for more.
absolutely, absolutely. And you were at the AICPA conference last week.
Yeah, so last week we were at the AICPA Forensic and Valuation Conference. It was in Denver, Colorado, which was nice to go out there. Great, beautiful area. At the Gaylord Resort, which is also another great resort. It was
Absolutely.
very, very, very interesting. Um, I've been going to the conference for probably like 7 or 8 years. Haven't missed it. Have presented usually I present at least once, sometimes twice at the conference. It's much different presenting in front of your peers as opposed to like a lot of the other presenting we do in front of lawyers, because your peers know a lot more of what you do than the attorneys do.
Right.
So it can be a little intimidating. Um, but everybody is kind of in the same boat. Everybody, things change over time. So you always pick something up new at the conference, at some new session or just something from a different session. And sometimes a lot of it is like, hey, you know what? We actually know what we're doing.
Yeah.
We're
Yeah.
doing the same thing that, we're doing the same thing that they're doing, so that
It
can be,
validates it validates it.
it validates it.
Yeah.
And,
Yeah.
like I'll give you an example. There's three ways to value a business. There's an asset method, an income method, and a market method. And probably, when I first started doing valuations and even over time, the market method was always the more challenging one, right? Because it was hard to find comps, it was hard to get information, it was hard to know, what the background is from that information. And so the past couple of years, I've gone to a session about the market method and really have picked up a lot of new information on it, and kind of a different angle of how to look at it. And like some people will say, one of the things we picked up was, people say, well, these transactions are old. You know what I mean? Like if they've got to be new transactions. And the presenter, woman Lisa Cribben, who actually last year I did a podcast for the AICPA with Lisa on her presentation. So if anyone wants to listen to that, they can go to the AICPA website. Shameless plug.
There you
But
go.
one of the things that Lisa pointed out was like when we do a capitalization of earnings rate and we develop a cap rate, we're using rate of returns from like 1920. And
Okay.
so those rates of returns are, if not anything, are older than the comps that we're using on the market method,
Right. Right.
you know?
Yeah.
And the other thing is, I think that what happens is, especially as we get older, kind of us old goats, Charlie, like us, we tend to do the same thing over and over. And you always have to adjust because now there's so much more information out there,
Yeah.
right? There's more databases.
Right.
There's, the information that we can get. It's why I always say the younger generation is so much smarter than we are because let's say at their age, when we were their
Right.
age, because they have so much information at their fingertips than we ever had, you
Absolutely.
know?
Absolutely.
And what they don't have over us is experience,
Right. Right.
because you can't get experience from information.
Yeah.
But the conference itself, I think it's very good. I really would promote it, to anyone that's in the forensic space or the valuation space, you're gonna learn a lot. It's always really great to kind of, network with peers and talk about valuation or talk about forensic and, different methods and things. Be careful if you bring your spouse because they're probably going to be bored at your conversations, you know. My wife's an accountant too, and my dad used to say that we would never have to worry about anybody eavesdropping on our conversations when we would talk about work, right?
There you go.
Um, but yeah, no, it was good. I do a presentation every year, probably for the past 5 years with Natalia. I'm not going to try to pronounce her last name because I'm going to butcher it, but Natalia's from Montana, which is like, who would ever thought I'd be doing a presentation with someone from Montana?
Sure.
And don't even ask me how we got there, but we did.
Right.
We do a case analysis. Excuse me. We do a case analysis study, and whatever some current cases that came down that have valuation components to it. Um, Last year we had a case called the Connelly case, which talked about how life insurance is treated in the value of a business, and it was very controversial. I would say 90% of our presentation was about the Connelly case.
Hmm.
That was it
Why
was
is that? Why is that controversial?
it was controversial in that the IRS included the life insurance proceeds into the value of the business,
Okay.
which probably doesn't, in my mind, doesn't make sense
Right.
because you
Right.
also have the if you have the out liability on the other side, then it should offset.
Right.
So
Right.
we'll see what happens there. This year we had a couple of cases. I presented on one case. It was May versus Peterson. It was an Alaska Supreme Court case. It was husband owned a small law firm or was a partner in a law firm. Um, One of the challenges with some of these cases is you don't know all the background, right? So
Right.
we talked about that before we hit record. Um, but he owned a he had ownership percentage in a law firm. So it's a marital asset. So you have two valuation analysts coming in, and one values the law firm at $22,000, and one values the law firm at $2 million.
Yeah. That's a
His
big
por-
gap.
his portion. You can see why some of these cases go all the way up to the Supreme Court, right,
Sure.
on appeal.
Sure. Yep.
So judge rules in favor of the $22,000 for a value. And again, we don't really know how big it is. We get the impression that the law firm's pretty small. And the difference in the two valuations was that the valuator who valued it at $22,000 said that most of the value was in the attorney himself, which is really goodwill.
Mm-hmm.
So there's two types of goodwill. There's enterprise goodwill or business goodwill, which is the goodwill of the whole law firm. And then there's personal goodwill, which is just the goodwill of the individual. And the concept is that, if I'm a lawyer and I leave, my clients aren't going to stay with that law firm. They're going to follow me wherever I go. They're only there for me.
Right.
And there was a lot of questions that, even I had as far as like, well, how big is the law firm? Because if it's just two guys, or a guy and a girl, whatever, you can see where the value just is in that person.
Right.
But if there's other attorneys there, if there's three or four attorneys that work for, this particular attorney, is it really goodwill? And if you look at our firm, it's kind of the same thing, right?
Right.
We're
Right.
we're experts. The attorneys come to us to be experts, but that doesn't mean that all the personal goodwill is ours, especially if we have people underneath us where,
Right.
you know, um, I know, I'll give you a specific example. I know, Emma French, who works with me in valuations, some of the attorneys are starting to call her
Right.
because they know she gets the work done,
Right. Right.
right?
Yeah.
And they know she's going to be responsive. Now, would they have her testify at this point? Probably not. But you would think over time, the more that relationship gets established, the more that my personal goodwill transfers to enterprise goodwill,
Right. Right. Yeah,
right?
that's
So
good. That's a good point.
you don't know what what the makeup of that firm was.
Okay.
And personal goodwill is very difficult, you know. Um, it's really hard. Enterprise goodwill is marketable. That's something that can be sold.
Sure.
Personal goodwill is not marketable, can't be sold, and it's not a marital asset that gets
Okay.
divided. You
Okay.
know,
Okay.
we had a case a few years ago, the Kwok case, which was a dentist, two dentists that I valued that dental practice, and the dentist one is the easiest one to explain. So when you look at personal goodwill of a dental office, I go to a dentist that is in my hometown. That the reason why I went there, it was next to the office that I worked in.
Okay. Convenient.
And I still go there because it's convenient. And quite frankly, if that guy, I love my dentist. I think he's a great guy. If he sells that practice and another dentist comes in, I'm probably going to go to that other dentist because of where it is.
Right.
You know,
Right. Yep.
whereas other people who have a relationship with him, I think he used to be in Holliston, and then he was in Milford, and then he's in Medway, and they followed him all around where he went.
Okay.
That's
Okay.
the personal goodwill. Those clients are
Right.
the personal goodwill.
Gotcha.
So,
Yeah.
that case, that was a personal goodwill case of a dental practice. I think it's in Brookline, Mass, and went all the way up to the Supreme Court. And the judge that they ruled in our favor that they didn't change our valuation and what they accepted. So
Okay.
that was good. So personal goodwill is very difficult and very challenging.
Okay. Okay.
Um, the second case that I worked on was, um, it was called Seagull versus Rethink Capital Partners. It was actually a Westchester County case that I don't think it's, I don't think it's in the Supreme Court yet. I think it's still out there, but there was an issue. It is in the Supreme Court, but there was an issue. So Rethink Capital has partners. Um, Co-founded by a guy, Richard Seagull and Ray Waldner. Anyways, basic background of the case is you've got a company that has a minority shareholder at, like, I think it's like 13%. In their operating agreement, it says that if there's a dispute or if one person wants to get out and wants to sell their shares, then they both agree to hire an expert to value the company. And then they're both involved in the interview process and the whole process of the valuation. I take it back. It wasn't 13%. I think it was like 49%. So you got
Okay.
two partners. One's a minority share, but still very involved in the business, not just like
Right.
someone that's an investor.
Right.
So the company hires the valuation company called Anderson. And it says in the case Anderson, and I'm like, wait a minute, when was this case? Oh, not the same, not Arthur Anderson.
Right. 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 Right.
They've been long gone. So this
Right.
company Anderson.
Okay.
So Anderson does their valuation. They only interview the company. They don't interview the other shareholder. Um, the company gives them forecast for which they base their valuation on. The forecasts do not reflect anything that's happened historically. So there's a bunch of issues there. There's, they didn't they didn't interview. They used a discounted cash flow method based on forecasts that the company gave them. They didn't match anything historically. They didn't ask them about it. They didn't critique the forecast. They didn't put anything in their report that indicated that they questioned anything. Um, the operating agreement says the purchase price is equal to fair value. Um, they used fair market value. The difference between fair value is really defined as equitable distribution. So in other words, it's what's equitable, not necessarily what you can buy on the street. Fair
Right.
market value is willing buyer, willing seller, neither under the compulsion to buy or sell, both knowing all the relevant facts. Fair market value usually includes discounts. It includes a discount for lack of control, because he only
Right.
owns 49%, includes a marketability discount, because you can't
Okay.
convert it to cash right away, right?
Right. Right.
It's not like I can call up my broker and, I can get my money in 3 days, sell my interest.
Right.
Um, so, you know, and quite frankly, it doesn't have to be a marketability discount. You already have a buyer, right?
Right. Right.
So
Right.
that can convert it.
Sure.
So they have all these issues with the valuation. Um, what ended up, and some things that are kind of on the side, and there's a couple of other things I heard at the conference. One was there was a panel and there was an attorney on the panel, and the attorney said that I don't like having a joint appraiser because I feel like the joint appraiser is trying to make, both sides happy. They're trying to come right down the middle. My response to that would be, well, number one, I I should know what the middle is. I should have no idea what either party expects. I should just come in, I should value the company and go home. That's how I phrased it before we started recording, right? You come in,
Yeah.
you're, you know, I think some valuation experts, think it's their job to help the attorneys win the case or to help their client get as much as they can or
Right.
pay as least amount as they can, depending on what side they're on. And that's about as far from the truth where you can really get yourself in trouble.
I mean, you're
You're
looking to come up with a number, right? I mean, that's pretty much what you're
it,
being engaged for.
yeah, your engagement is what's my opinion.
Yep. Yep.
I'm an advocate for my opinion, not for my client.
Right.
And really what you're there for is you're really there to explain your number to a trier of fact, to an independent third party,
Right.
right? Because those are the people that matter. The
Right.
attorney may never call you again. The client certainly probably not going to call you again. Um, when I'm hired as a joint appraiser, like I said, I like to come in, do my job, get out, and I don't even really care if what happened. You know,
Right.
um, the I think a lot of times in my experiences, I always say kind of tongue in cheek and kind of half joking, like if both sides are really pissed off, I probably did a good job. Right?
Exactly.
So, so, I mean, so the joint appraiser, there's issues there. And, I was on discussion with an attorney yesterday about a webinar that we're going to do. And we even talked about, you really got to ask for attorneys, you have to ask the appraiser a lot of questions, right? Look, I don't like everyone else, and I think we've talked about this in the past. Like, it's not fun when we have attorneys redlining our engagement letters. But with all due respect, they should understand our engagement letter. You know what I
Right.
mean? They should
Yeah.
understand about how we get paid and how our, opinion doesn't, you know, affect the outcome.
Right.
Um, so just to kind of circle back to the case, they also valued it at like $4.7 million, and they had a valuation done a couple of years prior to this for a different reason, and the valuation was like 40% of the prior valuation, so it came
Oh,
in really
okay.
low.
Wow.
Um, the court ended up throwing out the valuation expert, saying that, forget about all the things that the valuation expert did wrong. Just the fact that they both didn't agree wasn't in compliance with the current operating agreement.
Oh, okay. Okay.
You know,
Interesting. Interesting.
and I think, one of the things another thing that I always talk to about attorneys is, we actually did this presentation up at the Sagamore for the New York State Bar, Trust and Estates Group, about operating agreements and buy-sell agreements and how to be careful about what the wording is in those agreements, because it really can affect how litigation goes when you have either a shareholder that wants to retire or you have some type of shareholder dispute. You know?
Interesting. I guess a question I have is how does a case get that far along where the expert's report is thrown out when the agreements are pretty clear that, both sides have to choose that appraiser, right? That
Yeah.
valuation expert. Um, I mean, I guess what sort of due diligence was there on the front end to verify that, right?
Yeah. And also too, you know, what does that wording mean? So what if they can't agree? What happens?
Right. Right.
You know what I
Yeah.
mean? Or, one of the things that I always recommend is, you know, in a perfect world, your operating agreement, your buy-sell agreement, you pick an appraiser and you have your business appraised every year. Now, realistically, no one's going to pay for it every year,
Sure.
but you value it once. You agree, you pick the appraiser then,
Right.
right?
Right. Right.
Because because if you have a shareholder dispute, or God forbid, if one of the shareholders dies or whatever, you know, you don't know whether you're going to be the buyer or the seller, right?
Right.
Especially if it comes
Right.
to death. I don't know who's going to go first, Charlie. Either I'm going to get hit by a car or you're going to, whatever. You know what I mean? Like
Sure.
you don't know. So you're
Right.
going to be you're going to be pretty fair when you're not the buyer or the seller. So you already pick
Right.
someone, you have them appraise the business, and then you update it every few years.
Right.
And it doesn't really cost you that much, unless something major changes.
Sure.
So now that way you already have your appraiser,
Yeah.
right? You already
Yeah.
have you already have someone coming in, you know. Um, I was made aware yesterday of a situation where there was an independent appraiser. They both agreed to hire it because it saves money, quite frankly,
Sure.
and it works in some cases. Well, one side doesn't like the number, and they don't like the number, so in the engagement letter for the appraiser's engagement letter had, I will only testify if both parties agree to have me testify.
Hmm. Okay.
So, which quite frankly, I think is crazy. I can't imagine me putting that in my engagement letter. But so now they can't even submit the report into the court as evidence because the other side disagrees to have him testify.
Right. Right.
So
Wow.
that's an example of the attorneys. You really got to read the engagement letter and say, well, wait a minute, we're not agreeing to this because this could just hold up the whole thing.
Right.
And what will happen is, now you have a situation where now it becomes a battle of the experts. You see that
Right.
a lot in operating agreements too. If the company hires an appraiser, if the shareholder doesn't like it, they can go hire their own appraiser. And if the two appraisers aren't within 5% or 10%, then you go hire a third appraiser, and you either average the two closest ones or the third appraiser, which I always say to people, you you still cannot get to the right number, you
Right.
know.
Right. Right. Yeah. Yeah.
So another alternative for that is, if you don't like it, you can go get your own appraiser, and then if they're not even close, then you can go get a third person that can critique the two appraisals, which
Okay.
is a little bit less expensive and probably, actually, because I've had that situation before too. And because here's what happens, in the situation that I had, we had that, and the appraiser on the other side was their accountant,
Okay.
who wasn't necessarily an expert.
Right.
So you have an expert versus someone that's not necessarily an expert. And so if you do the whole average thing, you're still not going to get to the right number.
Sure.
So we both agreed to hire somebody um, that was like in Colorado or something. I actually knew the guy from the AICPA, from going to the AICPA conference. And I don't think the other guy knew that, but I knew this guy's not going to, I don't know him well enough where, he's my brother-in-law or something. He's going to pick my appraisal no matter what. And he came in, he picked my appraisal and made maybe two minor adjustments and said, this is the one. And
Okay.
said, look, and he actually loved it. He says, I'm going to recommend this. This is the way to go.
Okay.
Because you have, if one's 6 million and one's a million, and then someone comes in at, you know, 4 million, that doesn't mean that it still could only be worth a million, not 5 million if you average the other two.
Right. Right. Yeah. That's true. No, that's a good point. That's a
You
good
know what I
point.
mean? So,
Yeah. Yeah.
these are things that, like, I think attorneys, when they're doing their operating agreements and their buy sell agreements and things like that, um, really should consult with the experts to say, okay, what's wrong with this? You know what I mean? Or how do we word this so that we can explain them? Sometimes there's not even a standard of value in there. Is
Right.
it equitable distribution, or is it fair value? Is it fair market value? Are you taking discounts or aren't you taking discounts? And there can be certain scenarios where, if something happens, if a shareholder gets disabled or unfortunately, passes away, is it equitable distribution? Is it fair value? If a shareholder, because we had a case like this before too, where it was three shareholders and they had a startup company, and each one of them had a very prominent role in the startup, and one guy just decided he didn't want to do it anymore.
Yeah. Okay.
So is that equitable distribution, or should that guy almost get a penalty of marketability discount, discount for lack of control? Should be bought out at a discount just because he wants to get up and leave?
Right.
You know what I mean?
Right.
So different scenarios can have different, different standards of value.
You got to wonder how much this stuff is contemplated when these operating agreements are put together, right? And you would, obviously, to have a thorough and, I guess, ironclad operating agreement, it'd be good to have this stuff taken
That's
care of on the front end, right?
Yeah, and that's kind of what we try to hammer with the clients. I know I know when I was at a prior firm, we were doing a tax update, and you know how you have like polling questions. So we tried to gear the polling questions to cross-selling,
Mm,
right? Which I thought was a brilliant idea.
sure.
And one of the polling questions were, one of the polling questions was, do you have a buy-sell agreement or an operating agreement that says how you get out of the business? 64% said no,
Yeah. Yeah.
right?
Yep.
And then another polling question was, when's the last time you updated your buy-sell agreement?
Right.
3 years, 5 years, 10 years.
Yeah.
Since we created it, it was
Right.
like 80% since we
Yeah.
created it.
Yeah. Yeah. I guess it's like one of those things that this just you're not on people's radars, and I'll use an example because obviously I do a lot of work in the insurance industry, and you're you know a lot of policies don't have a specific dollar limit, right? They're based off of actual loss sustained. So if you have an income loss, and we got to come in and do a valuation of what the loss of income for let's say a restaurant has a fire, and they're going to be
Hmm.
down for 6 months, and we got to estimate what that loss of income is. You know, People don't think it's going to happen to them, right? So people,
Yeah,
so you're not going to talk to your agent and say, hey, listen, my business has grown over the last 3 years. Maybe I should up my insurance if in fact you do have dollar limits on your insurance. It's like your business income limit might be like $2.5 million, but now you're like a $30 million firm. You probably should up that insurance, right?
right. Same thing if there's life insurance funded in a cross
Right.
purchase agreement, right?
Yes.
As
Yep.
the business, you do it when the business starts,
Yeah.
and especially if you're younger, right? Because the cost of life insurance when you're younger from I don't know, from 1 million to 1.5 million or whatever is not as significant
Right.
until you get older like us, right?
Sure. Sure.
That you don't look at it and you don't update it.
Right. Right. Yeah.
They say the biggest mistake people make in estate planning is no one thinks they're going to die.
Well, that's it,
Mhm.
right? You don't think these events are going to happen. You think it's, and again, I use the example of the insurance work that I specialize in, and people don't think they're ever going to have a fire. They don't think they're ever going to have any kind of a catastrophic event where they're not going to have that income coming in every month, and they're
Right,
completely shut down. And that not only impacts them, if they have depending on the size of their firm and the size of the company, they have employees that they're responsible for, and that's going to impact
right,
them as well. So,
right.
obviously taking care of things on the front end, right?
Everything's so specialized now that, you really shouldn't have jack of all trades, right? Like, and again, not to criticize the attorneys, but when they use standard language, you know what I mean? And they don't know, when you do the whole battle of the experts, this valuation person, this valuation person, this valuation person, I mean, that could be like 70, 80, $100,000 in expert fees.
Right, right.
just
Yeah,
just pick your guy or your girl or your company before that. Have stipulations. If something happens to them, then here's the second person in line, and here's the third person. And it sounds like it's a lot of money, right? But if let's say it cost you $24,000, $25,000 to value your business the first time, I can tell you right now, litigation's a lot more than that.
yes, yes,
you
absolutely.
know,
Makes sense.
it's penny wise and dollar foolish.
Yep, yep. I'm going to shift a little bit here. Let me ask you a question. What are you reading right now?
What am I reading?
Yeah,
I am actually reading the Bible.
is that right?
Yeah, so kind of a long story. Um, my wife and I are in BJ's one day, and I see this book, and I'm looking at it, and it'll tell you like what to read in the Bible, and then it explains it, and it's like 2 pages. It's like a
Okay.
two-page summary.
Yeah.
So I kind of started with the Old Testament, um, switched over to the New Testament really fast, um,
Why is
and
that? Why is that?
it was just really hard to follow. It was
Okay.
really hard to, once I got into like the life of Jesus, it was more fascinating. I finished that. I'm kind of like on Corinthians or whatever, and um, I'm struggling with that a little bit because it can be tough to read. But
Yeah.
then when you have that summary and it tells you exactly like, and I'll just give an example. It talked about the apostles and that they actually think the apostles were like really young, like 13, 14, 15 years old.
Okay.
That there's some version of that. And, in addition to that, my wife and I were watching The Chosen, which I highly recommend. And as I'm reading these and seeing the same stories, on the show, it really connected the two.
Okay.
So
Good.
that was
Good.
that was interesting. Though I will say I was thinking like the other day, I already thought about what I was going to read after I was done. Um, but now I forget what that was.
Okay.
Drawing a blank. But yeah, I've never done it before. I mean,
Okay.
I did do like read the Bible in a year, and it probably took me a year and a half, but I honestly couldn't understand anything that I was reading. So
Okay.
having that
Okay.
having that summary and then having the chosen really kind of
Yeah.
put it all together was pretty interesting.
Oh, that's great. That's great. Excellent.
What are
Well,
you
Dave,
reading?
I'm actually reading John a John Grisham book. It's called The Widow.
I love the John Grisham
And
books.
I've read every one of us. So anytime a new book comes out, I get an alert from Amazon, and a new Grisham book comes out, I get alert, and I pre-order it, and it shows up when it's released. I usually get it like a day or two after it's released, so that's great.
Oh, there you go. That's
Yeah,
awesome.
yeah, yeah. I've read the first few chapters, and um, it's about a widow, and it's
How
he just grabs you. He really does.
he does, and he's so creative. I read his
Yeah,
books and go, "This is like what? How many books do you have out?" And you can still just crank them out. Like,
yeah. It's
you know,
amazing.
it's like the musicians, right? That just
Yes,
keep cranking out songs. Like
yes,
that's why we're accountants.
that's right. Yeah, we're not creative.
Not creative, yeah.
Exactly. Well, Dave, that's all the time we got for today. I appreciate you coming on, and look forward to following up and having another conversation at some point down the road.
Sounds good. Thanks,
All
Charlie.
right.